you can read market structure in the financial market, in the forex industry, whether you are trading cryptocurrency, whether you are trading forex, whether you are trading indices, then this video is meant for you. As a matter of fact, understanding market structure is the fundamental basic that every trader must know. If you don't understand the market structure, then absolutely you are a gambler, and once you are a gambler, you are born to lose money. But if you want to accelerate your profitability in the trading industry, then you need to watch this video to the end, understand the market structure from the basic to the advanced, how you can read the market structure as a pro without any experience. You're coming into the market. This video is meant for you as a beginner.
So basically, the strategy is comprised of three things. The first thing we put into consideration is our market structure. We talk about our time frame, confluence, combination or confluence, whichever one, because it really matters alone. Then we'll talk about our order block. And after our order block, then we'll talk about our TPI, which we use for final confirmation to enter our trade. So basically, this is the three things, the four things we'll be talking about, and this is what the four things the strategy comprises of, right? That's what the four things that the strategy comprises of. So the most important of all is the market structure. The most important of the market structure, and basically when we talk about the market structure, is the fundamental in trading. Once you don't get it right from market structure, you can't get it right. That is simple fact. So basically, we have three ways. There is three market conditions in the financial market, whether cryptocurrency, currency pairs, synthetic indices, or any other thing you could think of that is being traded in the financial market. So basically, is it that the what? Is it that we So basically, is that we have an uptrend, the market going uptrend, or we have the downtrend, and the final one we have the sideways, where we call it consolidation. So for the market structure, right, the strategy actually works on two, or we advise trade to, which is the uptrend or the downtrend. And so when we talk about the uptrend, basically we talk about market making a series of higher high like this, right? So basically, we take this to be our higher high, and then we take this to be our lower low. So we take this to be our higher high. We take this one to be our low, or we can call it higher low, whichever one you want to call it. All right, take this to be our higher low, and we take this to be our higher high. Right, we take this one to be our higher high. Take this to be our higher high. As that journey, put your mind so that you not disturb. So when we talk about this, right? When we talk about this market structure, basically, and sometimes we call this one to be our what? Sometimes we call this one to be our what? Call this to be our expansion. Let me just put it as E, right? And then we'll call this to be our retracement. These are fundamental things that you need to know. Many people have really find trading very difficult because the basic that you need to know, you did not know about it. Right. So basically now, by the time we now take words, this is our market structure for an uptrend. This is our market structure for an uptrend. So this expansion now, by the time we bring it out, we divide it into three perspectives. Normally, we usually divide it into three. We divide it into three, right? This expansion like this. So we take the range of this, right? So we have the middle part of it, and then we have the upper part of it, right? So for an uptrend, it varies right? So at this top here now, this is our higher high. Mostly we label it to be our premium, right? We label it to be our premium. We label it to be our premium, right? We label this one to be our premium. Please unmute your mic. So basically, we take the upper part to be our premium, right? And then the lower part to be our what? The lower part to be our. So we'll take the lower part to be our discount price, right? We'll take it to be our discount, right? And then we'll take the middle part to be our equilibrium. So for an uptrend now, this is how we categorize its equilibrium. Right? So in ideal situation, if the market is actually trending, right? So what you do is that once the first thing you need to do is that once you get out, you look at the market, you mark out these things, right? The premium, the equilibrium, and the discount, right? So in this situation, you should look to buy at discounts, right? You should look to buy at discount, and then you sell at premium. Then in some situation, the market might not actually retrace down to the discount level, but at least before you could think of buying, the market should retrace to the equilibrium, right? The market should decrease the growth. So what you do is that by the time you open your chart that you want to trade, the first thing you need to do is that go to your higher time frame, right? Go to your higher time frame. In this situation, this is what we are going to have. No, we have it like this. Have our higher high, higher low, right? So in an uptrend, so what you do is that you just go to your higher time frame, right? You take out the last swing or the last expansion, which is always going to be this, right? So you mark it out. You mark out the range. The range is very, very important when you are doing your market structure. You mark out the range, right? Let me change the color for the range. So you mark this out, right? To be your what? To be your range, right? And then you mark this out. You mark the highest point and the lowest point, right? You mark it out. My line is breaking. Is it applicable to everybody, or it's just you that have, my line is breaking up? So basically, you mark out the high. So this is going to be our premium, right? And this is going to be our discount level. Sefiu Mohammed, Sefiu Lakabir, I guess it's your network. Everybody could say it's okay. So you mark out the range, this expansion, right? Or let me just start from here. Let me just put this into consideration now so that we'll know. So you assume now you come to the market at this point here. This is where you came into the market, right? So the first thing you do is that this should always be done on a higher time frame, right? Depending on the kind of trader that you are, right? Depending on the kind of trader that you are. So let's assume the market is there currently when you enter the market or you open your chart. Before you could think of buying, you need to wait for what? Wait for this retracement here. At least, and then remember I told you this is going to be our premium. You don't ever make mistake of buying at premium. No.
Hmm? No, to back me change.
Please
No,
unmute your
ni
mic.
change. Ah, man, no will. What is the option? Back me change.
So basically, you do what? Let's assume you came to the market at this point here. This is the mistake majority of us make. By the time you see the market going on, wow, I've missed the setup. Let me you just enter the market at this very point here. It's very, very bad. Very, very wrong. So I make the market like this, market will keep going, and then you say, oh, it's wrong, it's wrong, it's wrong. Market keep reversing. Market keep reversing. So let's assume you open your chart and the market is there. Remember, just mark out this range here. Mark out this range, right? So you mark out this range to be your what? You mark out this range. So this is going to be your what? This is your higher high, right? And then you mark out your range here to be your what? To be your, you mark out your range here. Mark out your range here, right? So this is going to be what? So in this situation, this is going to be your higher high, right? This is going to be your higher high, right? On what? On higher time frame, that whichever higher time frame you want to work with. By the time I get to time frame combination, I'm going to talk more about like higher time frame. But mostly you should always look for your what? For your market direction on your 4 hours time frame or your daily time frame, right? But virtually it depends on the kind of trader that you are. But as part of majority of all new traders, we always fall at the what? At the intraday level of traders. So mostly you go to your higher time frame, which is going to be your 4 hours or your daily time frame, and then you mark out the last swing the market has made, whether it's an uptrend or a downtrend. The same thing is applicable to what? To a downtrend or an uptrend. So this is going to be your what? This is going to be your higher low, right? So in this situation, you see this expansion here, let's assume this is our 4 hours time frame, right? This is our 4 hours time frame on our H4, right? So let's assume this is our 4 hours time frame. So this expansion here, remember we call this one expansion that you see as what? As a straight expansion to the right hand side. By the time you go to your lower time frame, this is what you are going to be seeing there, right? This is what you are going to be seeing on your lower time frame. Your higher high, higher low, higher high, higher low, higher high, higher low. This is what you see on your what? On your lower time frame, right? This is what you are going to see on your lower time frame. So by the time you open your 4 hours time frame, you see this expansion, mark out the range here. If this is going to be what? If this is going to continue to be an uptrend, we expect them to what? To take out this high, right? We expect the market to just come down like this and come down like this, and then we'll take out. But the moment they break this swing low here, this lower part of it, we are in a downtrend. There's what we call break in market structure. So is it that if it's going to be an uptrend, they have to what? They have to break the market in the upside. If you look at it from here, wherever we start our uptrend, we have this higher high, right? Higher low, higher high. There was a what? There was a break in market structure here. There was a break in market structure. At this one, they take out this. What just my break in market structure? The ability of them to take out the liquidity here, right? They break the structure here, and then they expand to the up. So they break a retracement back, and then still break the what? This structure here. There's a PMS here, right? So if this is going to continue as an uptrend, then that means they have to take out this high here, right? But the moment they take out this low here, that means there's a change in market structure. So that means you should look for what? For a sell setup. I don't know if you are following me.
You are making sense, sir.
Okay. So if this is going to be an uptrend, they should break what? If this is going to be an uptrend, right, that means they should take out this what? This high here. But when they take out this low here, that means there's a change in market structure, right? That means you are looking for a sell setup. It doesn't mean that, okay, you now have to wait. So this expansion now, you take the range of it out. You take the range. You take the range of it high, right? You take this range, right? And this is what I'm telling you now. So this range here now, basically you divide into 3, right? So you just take out your rectangle or your Fibonacci or any other means you want to measure the range here. But mostly I use Fibonacci. So you mark it out from your what? From your high, from your swing high, your higher low to your higher high, right? This is going to be the middle range of it, right? So this is going to be your equilibrium, right? This is going to be your equilibrium. And this higher high is going to be your premium price. This is going to be your This higher high is going to be your premium price. Why this higher low is going to be your discount price. So in ideal situation, even in the real market, you don't expect to buy when the price is high. You rather wait for the price to be what, to be low before you buy. You buy at a low price and you sell at what, at a high price, right? So this higher high is going to be our what? It's going to be our premium, right? It's going to be our premium. Permit me to just abbreviate it as P, right? And this the middle range of it now. The middle range of it now. Let's take it. This is going to be our middle range, right? So this is going to be our equilibrium. Permit me to just abbreviate it with E so that I will not waste time. So this is going to be our equilibrium, and this higher low now is going to be our discount. So in this situation, the mistake many of us make is that by the time you see this expansion, you realize, wow, you missed a pure trend. You just enter the market, bam. And when you are entering the market, you do not take note of these things, this premium, discount, and equilibrium. The market is already at a very high price. It is not advisable. It is not of good advice. You buy when the market is high. Don't worry, I will still go into the chart so you see it directly. But let me explain very well before we move to the chart. By the time I get to the chart, you understand more better. So this is going to be the what? The equilibrium price. So in this situation, you should wait for price to what? To reverse from this higher high at least to your what? To your equilibrium before you can think of buying. In some instances, they can pass your equilibrium, right? Some instances they can, but at least they must what? They must reverse to what? To your equilibrium price. At least they must what? There must be a retracement back to your equilibrium before you can think of buying. Before you can think of buying, right? So at least they must make a retracement to this point here. At least they must make a retracement to this equilibrium price. Sometimes they might tend to expand directly. They might go beyond it, but at least before you can think of buying, price must have replaced 50% of the time of this former range that we have. Then from here now you can now look out to buy. So at this point here, this equilibrium, by the time you look at it very well, you might find your other block. Most times you find your other block here. Your other block or your breaker, you find it at this equilibrium. Anyway, from this equilibrium to discount is a very good place to buy based on your setup, right? But don't make the mistake of buying at this. So it seems that it's capable to work to a downtrend. And then when it comes to breaking market structure, taking out this high now, we label this area to be our what? We label this area, this high now, when they take it out, we call it BMS. BMS, right? We call it BMS, and then when you take out this I too, we call it BMS, right? So for this BMS now, there are two types of BMS. Take note of it. There are two types of BMS, and then mostly for any BMS, there must be a candle close. Every BMS must be confirmed with a candle close. So this now, right? Let's assume it's your normal bearish candle. Let's assume your normal bearish candle. You have your wick like this, right? You have your wick like this. This can be a what? Can be a wick and can be a full candle, but there must be a candle that will close above this previous swing here. There must be, whether it is a BMS at the premium or at the discount. If it's here too, if the market is coming to break this low now, there must be a candle that will close above the former range. If there is no candle that closes above the former range, it is just a liquidity graph. Don't make mistake. That means this range is still valid. So for us to now to take out this line, there must be a what? There must be a candle that will close above this high, right? Above this high. That means by the time we see a candle that closes above this high, that means the breaking market structure is confirmed, right? So let me just move to chart and then we'll show a practical example of it on chart. Then you understand more better. But any question so far?
I have questions, sir.
What's the question, sir?
Yeah. Uh, the candle you said, the candle that we will consider, which will close on the at the premium level, must it be on the time frame, on the particular time frame, like this 4 hours time frame? That means if
Mostly
the
it should be
candle
on your,
closes,
or it should be on your higher time frame, right? It
okay,
should be on
it
your
will
higher
start
time
on
frame that you use to determine your what, your trend. It should be on
okay,
your higher time frame. But sometimes by the time you go to, this is where your market, your time frame combination comes in place now. On 1 hour time frame, it can be a candle close. But by the time you get to your 4 hours time frame, it's just going to be a week. So this is where your ability, your knowledge of time frame combination now comes in place. You understand? But mostly on the time frame you are putting into consideration as a higher time frame, it has to be a candle close for your breaking market structure.
okay,
Mr.
okay, sir.
John, you are raising your hand. What's the question? Any problem?
Yeah, my question is it advisable to trade during retracement, I mean?
Well, you can trade the both. You see, the fact is that when we are waiting for this retracement to come down to your equilibrium, you can trade it. You can trade it because you already know and when you are trading it, you should look to take your profit at this equilibrium level and based on some POI, point of interest. You understand? You can trace the retracement back to this equilibrium level, but it all depends on how versatile you are with the market. You understand? I trade both ways. I'll buy, and then when the retracement comes, I would still sell. Mr. Yela, what's your question? You are raising your hand.
Yes, sir. Sorry for that, sir. At the retracement point, at the equilibrium point, you know, there are times it will give maybe a reversal pattern. That means it wants to go up, maybe like AMA, yeah, AMA. But at the end of the day, maybe if you enter the trade, it will start going down again. So, what are the confluences we need to consider at that
See,
equilibrium
when it
point?
comes to market structure, but like I said, market structure is really the basic of everything. You see, the reversal pattern you're talking about now, each market, we have two types of reversal pattern, type 1, type 2, and then type 1 is subdivided into 2 part again. So by the time you are waiting for your break in market structure, you understand, right? Or your retracement to go back, there must be one out of the 4 market, the reversal pattern that you find there. There will be one out of the reversal pattern that you find there. So let's move to the chart. Let me share my screen, then we'll go to the chart. We'll see a practical example of it. Anyway, so we are running out of time. Okay, we're having less than 10 minutes. I hope you can see my screen.
Yeah, we
Yes,
can see your screen.
The chart, right? Okay. So like I said, so you go to your higher time frame, mostly your 4 hours time frame or your what, or your daily time frame, depending on the kind of trader that you want. Better still, for the fact that I'm using synthetic indices, it doesn't mean it's not applicable to currency pair or cryptocurrency. It's applicable to, it's all the same thing all over. You understand? It's all the same thing all over, the same concept everywhere. The same concept that is applicable on synthetic indices is also applicable to what? To currency pair or cryptocurrency or any asset that you can think of. Or Google, you like open Google asset, MTN share, just open any chart. So far it has an open and a what and an I. You can always trade it. So can everybody just make a mention of choose any trade, any pair that I want us to work with that I'll use as a practical example. Anybody should suggest any pair we should work with?
this 75.
Use step index.
Sir?
Step index.
Step index. Okay. So one thing is that if you actually want to use this thing, but when it comes to trading, I would always advise you just to pick 2 or 3 pairs. Don't trade everything. We have more than 15 assets in synthetic indices with tariff. Doesn't mean you have to trade everything. If you say you want to trade everything, you will not be profitable. Just pick 2 or 3 pairs and then you master this. You understand? So you go to a higher time frame. Right? You go to a higher time frame. Okay. So you go to a higher time frame, mostly your what? Your 4 hours time frame. Right? Remember what I said earlier about. So for step index now, there's another thing I forgot to mention. You see, okay. Now the last swing, right, on this 4 hours time frame now is going to be this. Right, this is the last swing. Right. Let me make it green so that we know that's our high. And let me more put that. So you know that this is going to be our high. Then you mark out the low. This is going to be the low, the lowest part of it. Right. That's the lowest part of it. Okay. Okay. Let's use red. Now we know that okay, green for buy and sell. So this is the what? This is the range now. This is the range, right? So on our 4 hours time frame. Now we want to catch out whether it's going to be a buy or a sell. So you move down to your what? To a lower time frame, and then you look at the previous swing. Actually, this is another swing. This is another swing here, right? This is another higher, lower high here. You can consider this to be our lower high here, right? But the larger one, this is going to be for our dot. This range is equally the same range with our what? With our daily time frame. By the time we go to your daily time frame, you see that it's still going to conform with your daily time frame structure. You can see what I'm saying, but it's still going to be the same range on your what? On your daily time frame. So that's why sometimes when you mark out your range on 4 hours time frame, most times it's still going to be applicable on your daily time frame, right? So this was our last swing on our daily time frame and also our 4 hours time frame. So if you are looking at your time frame combination now, let me go to your time frame combination. So basically, I tell you can choose three time frame you work with. One higher time frame, one medium that will be in between the higher time frame, and then one lower time frame. The lower time frame, you use it for your entry most times. And then basically for my students, I have a template of time frame I gave them to work with. Right.
Now.
You said?
Let me see.
What do you say?
Online. Yeah.
Okay, so for the time frame bar, we have this time frame confluence.
Inshallah, please mute your mic. Mute your mic. You're disturbing us.
So for the time frame combination bar, let me share another screen to show it. I hope you can see my screen.
Yes.
I hope everyone can see my screen.
Yes, yes.
So for the time frame combination, right? Like I said, you have to choose 3 time frame, one higher time frame, one middle time frame, and then one lower time frame. So basically, your lower time frame is what you use for your entry. Yeah, your higher time frame, you use it to confirm your trend, right? Then the next time frame that is a little bit lower to your higher time frame, you use it to confirm your short time trend. Understand? The higher time frame will always be for a long time trend. While the next lower time frame will be for what? For your short time trend, and then your lowest time frame will be for your entry. Right. So mostly as the kind of trader that we are, that every trader we are, we always try to be in between. Either you are a scalper or you are position trader, intraday trader. So mostly all 85% of traders that we have currently now are going to be is either you are an intraday trader or a scalper. We have very few people that are swing trader or position traders. So for that reason, I always advise you work with your higher time frame should be your 4 hours time frame or your daily time frame, right? Then either of the two, you can use any of the two. But conveniently, I choose to use this third one, your 50. So your lowest time frame is going to be your 15-minute chart, while your next higher time frame is going to be your 1 hour time frame, and then your 4 hours time. So your 4 hours time frame, you use it to confirm your long time trend. While your 1 hour time frame, you use it to confirm your short time trend. Then on your 15-minute time frame, you can now look for intraday trend. You understand? And then from that same 15 minutes now, you can also take your entry from it. Right? So you can take your entry from it. So let's go back to that. So our time frame that we are using is our 4 hours time frame, right? So mark out our range there, market structure there, which is this. So we mark out our range on this now, right? So the next thing we need to do is to go back to our to next lower time frame, guys. The next lower time frame is following the higher time, which is our 1 hour time frame, right? So we mark out our range on range like this. So we go to our 1 hour time frame, and then we'll check the short time trend, the short time market structure on our 1 hour time frame. So on our 1 hour time frame, this was the range that we have, right? So like I said, for the BMS, for the reversal pattern, we have two types, type 1 and type 2, right? I'll just run through it. So for the type 1 reversal pattern, right, we have it like this. If the market is coming from an uptrend like this, we have higher high, higher low, higher high. There will be a BMS. This is the BMS, right? Then we'll now have another BMS to take out this low here. Then you can now have your retracement back. This is type 1 reversal pattern. Like this is type 1 reversal pattern. You can call it your normal M, your advanced M, as the case may be. And then for the type 2 now, you have it to be like this. Higher high, pay to make a new high, and then you have it like this. So this is type 2 reversal pattern, and these are type 1 reversal pattern. So like I said, please, my reserve apology, but you have to bear with me with my background noise, because where I'm a little bit, I'm not at home currently, so and where I am is a little bit close to a traffic road, so there's noise. So just bear with me. I will try as much as possible to be very audible. So our last class, we talk about market structure, right? Where do we stop? How people will.
Hello, we are here. I think other guys disconnected somehow.
Okay, so where do we stop with our last class, part 1?
I was not here for part 1 anyway, so
Now, Mr. Lord.
kindly say. I said I wasn't here for part 1. This is my first time I was trying to.
Okay, so those who are available for part 1 and you did not see the video.
No.
We left at reversals. You were starting to explain about reversals.
You said what, ma? All right, no problem. So we're about talking about reversal pattern in our part 1 before network and some other things came in place. So we'll start from there today. basically we'll talk about reversal, our TDI, God's willing. So last time we were talking about our reversal pattern, and I did say we have two reversal patterns, right? We have two reversal patterns. For the reversal pattern, we have two. The first one is normally our what? We have it like this. So the idea, the logic there is that there is always going to be what? Two BMS. This is a break in market structure, and also what? A break in market structure at the what? At the top, right? And for the second one, we always have it like this. So there will always be one break in market structure. That's how you get to realize the difference between the two. So sometimes some will call this reversal for you to be this one to be your normal M, and this one they will call it to be an advanced M. All right. Then for this type, so normally we just call this one our type 1 reversal pattern. Type 1 reversal pattern, and then we call this one our type 2 reversal pattern. So for this type 1 reversal pattern now is subdivided into two, right? The first one is that you see the first BMS here, right? This BMS here now, this string high will just be a little, will be a what? Will be a graph in what? In liquidity. So sometimes a candle, remember when we talk about our market structure? When we talk about our market structure, I'll say there has to be what? A candle close to confirm our what? Our BMS. So for this type 1 reversal pattern now, right? For this type 1 reversal pattern, most of the time this so for this type 1 reversal pattern now, for this type 1 reversal pattern now, we have type 1.1 and our type 1.2. So for the 1.1, it's always going to be like this, right? The difference there is just that this 1.1 now, this area here, this finger now will just be a what? A liquidity. It's going to be a wick just to grab the orders, the stop loss above this area here. So that's just it. So most of the time you will not only see a candle close to confirm this one as a new swing, right? Then at the top too, is always going to, sometimes you don't have it like that too. But at this one, take note of it, is always going to be what? A wick, not a candle close. So that's how you get to know the difference between type 1 and type 2 reversal pattern. All right. So most of the time, for this reversal pattern, but you always find it at your what? At your lower time frame. It's very rare you find it on higher time frame. It's very rare you find it on higher time frame. I remember, like we did explain the other time, but you look at your higher time frame, your D1 and H4 preferably, and look at your market structure, and you mark out your what? Your range, right? You mark out your range to know where you are in the market, what you are expecting. So by the time you mark out your range on what? On your higher time frame, which is going to be your H4 and your what? Your D1, you can always go to your 15-minute time frame or 1 hour time frame and look for your reversal pattern here. And sometimes you can have it on M30 or your 30-minute time frame. It all depends on the kind of trader you are and the kind of time frame that you work with, right? But most of the time, you always find this reversal pattern at what? At your lower time frame. Because if you wait for it on higher time frame, my brother, you suffer. You wait tired before you see it. But on 15-minute time frame or 5-minute time frame maximum, lowest 30-minute time frame, you find this reversal pattern there, right? You find this reversal pattern there, right? So let me just go to the chart, then we'll look at it very well. I think that will give us a clear picture of it. So what chart should we look at? Can anybody just forget the chart we look at? Hello, Mr.
Hi,
Lawal.
okay.
Which chart should we work with?
Hello,
Which chart are we working with tonight?
let's go with VS 75S.
75S. Choose another pair. 75S is less volatile. Choose another pair. But if you want us to work with volatility, 75S, no problem. It says 75S bar.
Yes, you can go with 50S also, Sha. Either one of the two.
Yes, it's very volatile. It's not meant for small traders. But no problem, that is what you want. I don't have 50 years on my chart here. Choose another pair. I don't have 50 years on my chart here. Choose another pair.
Let's go with 100. 100X.
100 days. Hey, private. Okay. So template. So so the first thing we'll do is I will go to our daily time frame or 4 hours time frame, depending on the kind of trader that you are. Remember, I explained the time frame in our last class. So you choose whichever one you want to do. You want to work with as a higher time frame. So mostly let's start with our daily time frame. So we'll mark out our range on it. Stuff. So let's just work with our volatility 10, right? So if you look at volatility 10 very well. So these are volatility 10 bar. So the first thing you need to do is that what you mark out the last range that you have. So if you look at this market very well now, I can easily conclude that, okay, looking at it, right, we have this swing, right? This was our last swing high, all right? This is our last swing high. This was our last swing high, right? And this was our last swing low here, right? We're on the daily time frame. Or what you did to break it here, right? You are expecting a little buy. Mitigation, what we call mitigation. But if you look at it here, so automatically you know you are in what? You are in a swing high. So this is a what? This is another swing high here, right? Then this was the low that was responsible for this. So automatically this range become invalid, right? Because this is our what? Our recent swing high. This was our recent expansion, right? I don't know if you understand what I'm saying. This was our what? This was our higher low, right? then our higher high, higher low, higher high, higher low. Then we have this one higher high again, and we have this higher low. So in this situation, this was our what? Our last swing. This was our last swing. So you mark it out, right? You mark it out. This was our last swing. So this was our last swing. This was our last swing. So let me, okay. So this was our last swing. Then we can always go down to our what? This was our last swing. So in this situation, majority of us know about other block now. Or there's anybody that don't know about other block? Hello.
Yeah.
You are yet to explain the other block, sir.
So you don't know about other block, right?
You can shed more light, sir.
So other block basically is always the last candle in an expansion. We will have a series of uptrend, right? The last candle after each expansion will always be so we have bullish order block and we have bearish order block. So for the bullish order block now, you always find it at what? You always find it in a downtrend, if I'm not mistaken. So in an expansion like this, right? The last bear candle here before this expansion, the last bear candle here before this expansion here, right, will always be your order block. So in this situation, you expect the retracement to what? To come down to this order block and what? And move up. The last sell candle at this area here will always be what? So now if this uptrend is going to continue, you just need to mark out this order, the last sell candle here, right? Mark out the last sell candle here. And then you what? This is where you anticipate for what? For your retracement, for your new higher low, before you have the expansion. Then for a downtrend now, for a downtrend, the last green candle after each retracement, after each higher high, lower high, but will always be your what? Your order block. And that is where you should anticipate for what? For the next higher low, lower high to be formed. So the last what? The last, you just mark out this what? This last green candle here. So now in this situation, this is where you should look out for your what? For your new higher low to form. So if you look at this our swing here now, if you look at this our swing here, this was our recent swing here, but this. So the last order block here should have been this, right? This is our last order block here. Let me use triangle.
Yeah.
So that is where you should anticipate for what? For your what? For your next swing high to form.
Retracement.
These people now. So this is where our what? This is our last red candle here. So this is where you should anticipate for what? For your new higher high to form. So this is this is where you should anticipate for what? For our new higher high, the last candle here. So in this situation, if this uptrend is going to be valid, right? This is what we expect. The moment we have this expansion like this, higher high, then we should have an higher low at this other block and what? To move and break what? Look to break this structure here. But we did not have anything like that. Of course, they did respect this other block here, right? They respected it, but they were unable to what? They only give us a reversal, right? They give us a reversal. Now, if you look at this now, this is a what? This is our end pattern here, right? So this is the reversal here. By the time you go to your what, to your 4 hours time frame, you can able to spot your what, your reversal pattern, whether type 1 or type 2 at this area here, right? By the time you go to your 4 hours time frame or lesser time frame, you'll be able to see this reversal pattern at this area here, right? So ideally they respected this other block here, right? They respected this other block here. That was why you have this what, after this expansion like this, we'll have this and then we'll move up. But the only thing there was that they were unable to what, to take out this high. So the moment they were unable to take out this high, rather they come and what, take out this low. From here, there's a what, there was already a break in market structure. From here you start looking for a sell. So what you need to do is just what, is just to go to your lower time frame. It's just for you to go to your lower time frame and what, and look at for your reversal pattern, right? So by the time you go to your lower time frame now, so just mark out this area here now. So our new range automatically will change from this, right? Will now be from this, right? This is a mini structure. This is a mini structure. Let me change the color so that by the time we go to our lower time frame, we can always identify it out. So this is a mini structure here, right? It's a mini structure. So by the so by the time we go to our what, our 4 hours time frame, you just look out for what, for your reversal pattern. So on our 4 hours time frame now, it's very, very simple. Look at now, on our 4 hours time frame, we have this what, this area. This was the last swing. Let's consider it from here now. This was our what, our range on our higher time, on our daily time frame. This is coming from our daily time frame, right? So we did have this, we have this. So this was our what, our higher low. We have this as our what, as our higher high, higher low, higher high, right? This is the reversal pattern here. This is type 1.1, right? This is type 1.1 because the next low will have been this area here, right? But they what, they did come and what, and break the structure here. I don't know if you understand what I'm saying. Is anybody with me at all?
Yes,
Yes, sir.
Is it making sense?
yes, boss.
A lot of sense.
Sure.
Okay, so now the first thing you do, always mark out your what, look at your daily time frame and know the market structure where you are. Mark out the last swing high on your what, on your higher time frame. Then you go down to your 4 hours time frame. On your 4 hours time frame, you'll be able to see a what, a mini structure inside and even a more clearer picture on 4 hours time frame. So if we have not been there, or should we just use a recent thing so that we won't take much of our time, right? Because now this is going to be our what? This is our higher low, right? Higher high here. I think it's going to make sense like this. So this is what, this was our higher high, right? And this was our what? Our higher low. This was our higher low. And this was the recent higher what? Wow. This was our low, our higher low from what? From our daily time frame, right? And after this higher low now, let me remove this other block since you are not using it. This was our what? Our higher low, right? On daily time frame. Right. They will now have this what? Our higher low here and our higher high. So we expected to have our what? Another higher high here. Right. Now you look at your breaking market structure, right? This was the swing. This was the swing, right? If you follow the first class very well. So this was our what? This was our range, right? This was our range. We have this range that so when we break this market structure here, right? When we break this market structure here, so this was the what? This was the new. We now have this what? After this break in market structure that took out this high here, this automatically became our new higher low, right? So this become our what? Our new higher low here. So on our 4 hours time frame now, so this range now is no longer valid again. I don't know if you understand what I'm trying to say. So this was a recent swing, this was a recent higher low that we have. They will now have this higher high, right? We'll have this higher high here. So we are looking for what? Remember what we said about other block. So the last second before this expansion hub is going to be this. So in this situation, you should have taken a rectangle and mark out this other block here. So this is where you should anticipate for what? For a new higher low to be formed, right? But when the market got to this area here, it did not form, it did not respect it. So which is telling us automatically that what there was a break in market structure, right?
Yes.
So this other block would not hold price down here. So we had a what? A break in market structure here. Because they took out this range here, right? So this low could no longer low again. So there was a what? There was a break in market structure on this, right? So there was a break in market structure. By the time you expand this range down here, by the time you expand this range down here, right? So you had your what? We had our expansion here. Okay, we have less than 10 minutes. So automatically now, when we have this, this was our what? This become our what? Our BMS here now. So we have our BMS here, right? We have our BMS here. We have our what? Our BMS here. Hello, sir. So we have our what? We have our BMS here, right? We have our BMS here. So this is how you just label your chart to make things very easy for you, and then you know where you are, right? You know where you are. So we have our BMS here, right? So in this situation now, this is where your other block. So if you look at this now, if you look at this range here, if you look at this range here now, the last second now should have been this. So remember what we said about premium and discount the other time, right? You buy at what? At premium, and then you sell at what? At discount. So automatically now, this is the new range that we have here, right? So and we have this low here, right? So if you take out your Fibonacci, right, you should look out for what? For your range here now, right? So if you are looking for a sell setup now, at least it starts to be what? In your equilibrium region. So remember that this is our equilibrium here, right? So from up here, right? Anything above here is our what? Is our premium. We can sell. Anything below this equilibrium here is our discount. We can always what? Buy. So one good thing about your other block is that another major reason or major trick that will validate your what? Your other block is that if you are looking at your other block, if it is a buy, it has to be at your what? At your discount level. And if it is a sell, it has to be at your what? At your premium level. So once you mark out your range, you look at the other block that is at discount if you want to buy, and you look at for other block that is at what? At premium if you want to sell. So if you look at this range here now, this was the only other block that we have here. Here now, by the time we go to this range here, this range here now, right? You know, this is our what? This is our premium here. By the time we go to our what? Our lower time frame, there's most likely we'll find a what? We'll find another block at this region here on our lower time frame, right? That will validate it for us, right? But on 4 hours time frame, there's no another. This will have been the other block we are going to use on our 4 hours time frame, but we did not have any, right? So this is where the power of your power of time combination comes in place. So depending on the kind of trader that you are, you can go down to your 1 hour time frame or 4 hours time frame and look, or 30-minute time frame, and look at the other block that is at this region here, so that you can have your what? You can always take your entry. Since you have a what? A BMS to the what? To the lower side, there's a what? There's already a break in market structure. So we are shifting from an uptrend to a what? To a downtrend. So by the time we move so by the time we go to our what? Our 1 hour time frame, we'll definitely find another block at that area, right? We'll definitely find another block at that area, right? So this is our 1 hour time frame. There is not another block here. Let's check 30-minute time frame. But there's another thing at that region there, which we call our imbalance, right? Those are part of what we consider in liquidity, right? So on your M30 now, right? On your 30-minute time frame now, you can see this is another block here, right? This is another block here, which will have looked toward. Look at this area here. This is another block here before this expansion that took out this one, this cell here. So if you mark out this other block here, this is our last green candle, right? If you mark it out, it should what? It should correlate with that area there. Let me change the color so by the time we go to what? Our 4 hours time frame, I can always extend it there. So let me just go to 1 hour time so that I can extend. So now, if you are looking at your other block and your what? If you look at our other block now, right? If you're anticipating for your higher low, there are things you consider. You consider your imbalance, your liquidity, and your what? So if you look at now, once you mark another block, if there is a what? If there is a liquidity void, what we call imbalance in another block, right? Definitely they will have to feed that imbalance. So that is giving you more confirmation that another block is going to, that other block is a strong other block. The price would always what? Respect it. I don't know if you understand what I'm saying. But if you look at this area here now, right? There's a what? There's another block here. But before this other block here, we have a what? We have a liquidity graph here. Look at this. This is what we call an imbalance here. These three candles here now, ideally, but in ideal situation, they should have they should be interlocated around it. There should be interaction between the three candles. So most times when there is no one, that's what we call imbalance. For those who are into cryptocurrency, if you look at your Bitcoin on your 1 hour, on your weekly time frame, you will find that there's a liquidity on Bitcoin. There's an imbalance at that 19,000, 20,000 region there on Bitcoin. So most likely they will come back and feed that liquidity that imbalance that we have there before Bitcoin can be stable again. If not, it will still keep falling as it is. So those are the things. So those are the things you put into consideration, right? Because that your other block, your imbalance. I have done video on imbalance. You can always check my channel there, my YouTube channel. You see video where I did justice to what imbalance and liquidity. So just go and watch that video, and you can always have your question on it. So we anticipate for this word here, for this our higher high here, right? We anticipate for this our higher high here. So when we have a return to other block at this area here, So looking at our Fibonacci now, our equilibrium is there. So most likely, where did our higher what? So this was our higher high. We have this break in market structure. So automatically this become our what? Our low, right? Lower low. So this become our what? Our lower low. This become our lower low. And then this will now become our what? Our lower high here. So this will become our lower high here. Our lower high is forming at our what? At our equilibrium level, right? So that's one thing about your premium and discount level. So this gave you confirmation. By the time I just move this my Fibonacci here now. So our new range now will now be from this area here, right? Our new area will now be from this lower low here, right? So sorry, the first lower high that I have was at this area here, right? Then we'll now have this what? Break in market before we now have this. But this is just a what? A little internal structure that does not really mean internal structure on 1 hour time frame. That's it. So you really don't count it, but if you want to count it, you just confuse yourself. But you know that this is our major swing on our 4 hours time frame. So you take out this. So by the time they break this low here, right, we'll be looking to have another what? There was a BMS here, right? We'll have a BMS here. They will now have this lower low. We'll have this lower low. We'll have this lower low here, right? Then we'll have this BMS here.